Hi, Joe Cantu here, and I wanted to do an educational video on tax-exempt municipal bonds because in the investment world, they are timely. And what I mean by that is that in probably the last 15 to 20 years, we have not seen yields, tax-exempt municipal bond yields, as high as we have just in the last 6 months. So let's get started.
Welcome to Retirement Tactical Money Management. Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager.
So first off, what is a tax-exempt municipal bond? A tax-exempt municipal bond are basically loans that people will give their money to municipalities, governments, municipalities to build schools, roads, housing, airports, things like that, hospitals. And when you give them your money, they give you this bond, and the interest on it generally is tax exempt. Now, I'm not a tax person. I need to start off right off by saying that. But in most cases, it's tax exempt. Now, there are some exceptions. And let me just digress just for a moment. So, one of the reasons I'm giving this is back when I was a baby broker, I started working for a company in Houston, Texas. I'll call it a municipal bond house, but they also did initial public offerings for oil and gas companies. But they did many of the municipal bonds for the city of Houston area. And I learned quite a bit about municipal bonds inside and out, good things, bad things, things to watch out for. And because of that experience, I wanted to kind of relay that. And again, what is interesting is that in the last 15 to 20 years, you haven't heard people talking about municipal bonds or even bonds at all. And the reason behind that is because of the economy. If you think about it, we had Y2K happen where everything collapsed on the tech market. Then you had the financial crisis. And then we had kind of some bad economies, and then interest rates were zero, if you remember, during Bernanke's era. And then a year and a half ago, interest rates were zero. So just in a year and a half, we have seen the Fed funds go from 0 to 5.25%. Well, on the other side, that's infected the entire fixed income market, which we call the bond market. And now all of a sudden, interest rates are back up. Now let me go back in time. So I'm going to take my crystal ball and just go back in time a little bit. So we're a balanced manager, and typically as a balanced manager, you will own fixed income. Well, the other point about that is that normally when you set up an investment portfolio, and I had used to teach retirement and estate planning classes to retirees. This is before the internet. So the only way to learn about the investment markets is retirees had to attend a local college, go to their local college. And I used to teach these courses I taught for about 14 years. But one aspect of setting up a balanced portfolio is typically you wanted a portion of that in fixed income securities, bonds in other words. So, the typical balanced portfolio would be 40% bonds and then 60% equities. So equities, you take risk of the stock market in it. With bonds, you take so much less risk and it pays you interest income. And if you were more aggressive, then perhaps that mix would be 70-30. 30% fixed income and then 70% equities. But what's interesting, again, about all of this is that in the last 15 or 20 years, interest rates went to 0. And so when you saw if you went to see a financial planner or financial advisor in the last 20 years, 15 to 20 years, very few of them would recommend hardly any bonds in the portfolio. Now, if you went to a financial planner and he said, because of your age, we need to put more bonds in it, what's also interesting is if the stock market went up and interest rates went higher, you lost money. in your bond portfolio because you were overweighted in bonds, and so that's kind of unfortunate. So that for all those reasons above, that is why your investment advisor has typically not recommended bonds to you up until this last 6 months. And this last 6 months, all of a sudden, the bond market has come back. So I've told you what a municipal bond is, and they are tax exempt in most cases. There are factors, because I did teach high net worth retirement planning as well. One of the factors for a high net worth individual is they like tax exempt income. There's one small factor to consider, and again, I'm not a tax person, but if you are in a high net worth area, you need to ask your tax person, your accountant, if you're subject to alternative minimum tax. So if you are a high net worth individual, normally your tax person will do taxes two ways. They'll do taxes the regular way, and then they'll do taxes the other way, considering alternative minimum tax. This is for high net worth investors. And if you are subject to alternative minimum tax, some of these tax exempt municipal bond income, which is tax-free income, may not be tax-free to you because you are subject to the alt min tax. I just want to put that out front before we get more into the presentation. So now I've talked about what is a municipal bond, what makes them interesting in today's market because they're timely. And the first thing you need to look at is your marginal tax bracket. So let me give you an example of the marginal tax bracket situation. So if you look at this chart here, in the United States, we call it a tax schedule because it's not like a fixed, you're in a fixed rate and you pay that number. The word marginal means that the more money you make, you move into a higher bracket and you pay more taxes. So for example, in the United States, if you make $0 to $10,275, you are in a 0% tax bracket. You pay no taxes. Now, on the first dollar above $10,200, this is on last year's rates, $10,276 to $41,076, you pay 10% taxes on just that amount of money. And then likewise, on the first dollar above $41,776 or 75, you move into a 22% bracket. So again, the higher you go, the more taxes you pay, and we call it marginal. Now the highest bracket is 37%, and so if you make over 539,000 a year, 539,901 and above, you're in a 37% marginal tax rate. So let's talk about how to decide if you're getting a good deal on a tax exempt municipal bond. So again, a year and a half ago, you could probably get less than 2% on these tax exempt municipal bonds. Now today, I saw over the last 3 or 4 months, I've seen some tax exempt municipal bonds hitting 5%. Now, they're not actually 5% now because it depends on what rating you get. That's the lower rating, the higher the yield, the higher the rating, the less yield, and I'll explain that. But here's the formula to figure it out if it makes sense to you. So in my example, I'm going to use a 37% tax bracket, but the formula is you take your tax-free bond yield and divide it by 1 minus your marginal tax rate. So up above here, I put that inverse number for you. So for example, at 37%, that number for the bottom number we use here is 0.63%. So now let's take a look. So if you're getting a 4% tax-free bond and you divide it by 0.63, your taxable equivalent yield is 6.45. In other words, you would have to get a CD equal to 6.45, and after you pay your taxes, you're left with 4%. That's how much money you get back. What's interesting is if you can find a 4.5% tax-free bond, I mean, your taxable equivalent yield is 7%. You'd have to find a 7% taxable bond equivalent to a 4.5% tax-free security. That's why it's such a good deal. But I also want to show you that if you're in a low tax bracket, like for people who are fixed income, it doesn't make much sense. Because if you're getting 4%, you get a 4% tax-free bond, and you're in a low tax bracket, the taxable equivalent yield is only 4.44. You only get 44 basis points more. Or if you're getting 4.5% tax-free bond, you get 5%. That's only 0.5% more. It's not even worth it. So, and also if you have IRAs, tax-free bonds don't make sense in IRAs because you don't pay taxes on the bond anyway. So you should get taxable bonds in your IRA account. So this is only for non-taxable or taxable accounts. It's not for non-taxable accounts, I should say. Now let's talk about some of the reasons that a person may want a tax-free bond. Well, one basic reason, if you're a retiree and you're in a high tax bracket, you just may want high current income if you can get higher income tax-free. And if you want it tax-free, that's one reason. Now I'm going to talk at the end. I'm also going to give you a story at the end that's going to tell you a true story that happened to me and one of my customers, and why it's so important to do your homework when you're picking up some of these tax-free bonds. So anyway, the other reason is for the long-term stock market protection. You know, we've been in such crazy stock markets from 2000 all the way here until 2023. You know, financial crisis, and I mean COVID-19. I mean, if you remember during March, I believe it was March 16th of 2020, the stock market fell over almost 40%, I believe, in one day. And we've not been in situations so volatile like that before. So if you want to all of a sudden, there was really nowhere to run anymore because interest rates were zero. But now things have changed. So what if you want some protection from that? You want steady income and you don't want the volatility of the stock market. All of a sudden, tax-exempt municipal bonds make sense to you. So another reason to get a tax-exempt municipal bond is if you want long-term stock market protection, you can take a portion of your money and put it. Now, the question is, do you do it now or do you wait till the market rebounds? Well, you also have to decide if the Fed is going to start lowering interest rates, because if they start lowering interest rates, then these beautiful yields on these tax-exempt municipal bonds are going to evaporate. So that's why I'm giving this video out to the public, because I think it is timely. I think it is timely that you start looking at some of these investments, tax-free, that may fit your situation. Another reason for tax-free bonds is inheritance. And matter of fact, just this past year we had one of our customers, it was our customer inherited money from from one of their families who passed away, and they received in their portfolio some tax-free bonds. And so now, normally, over the years, again, I've been in the business a long time, but at least every year I've probably had maybe 4 or 5 meetings with different family members about these are the children who are going to inherit the investment portfolio. And one of the first things that I address to them is you really need to take a look at your tax-exempt municipal securities. And when you inherit this portfolio, you may not get rid of these. Now, again, the children, which may be 40s or 50s years of age, they don't understand that we were at a moment in time here in the United States when we got some of these tax-free bonds. And if we're in an environment where interest rates are lower, these tax-free bonds are valuable and you can't get them again. So it's important to have these meetings with these children of people who may inherit this money to let them know these are some securities that if you get the money, don't sell them if you want to continue to get tax-free income. Or the other situation is you may be able to sell them at a profit if in fact interest rates are lower. So anyway, these are discussions to have with family members talking about inheritance. And finally, the last person who's typically interested in bonds is that you can play the bond market for gains and losses like you can the stock market. But now you're playing the interest rate market over here, and it moves a lot slower rather than playing the stock market. And I'll just tell you a quick story. So this is back in the 90s. Actually, it was like early 93, 94, but I had this customer, and I went to see them, and he was the bond guy, and she was the stock person. So when this is back in the old days, and when we were selling individual stocks, and there was a commission. I mean, I made my living doing that. And so if I had a stock to present, I would talk to her. At the same time, she would look over the research reports that I would give her about say we were picking up 2 stocks out of 5, and I would present 5 research reports, and she would pick 2 stocks out of that, and we would put them in the portfolio. And then on the other hand, I had the husband, and he was the bond guy. In this particular family, they only bought tax-exempt municipal bonds. So I would typically show them, and this is again when the bond market moved very slow. So I would typically show him 3 or 4 issues, and he might pick out 1 or 2 of the issues, and pick up 5 to 10 bonds, and put them in their portfolio. But again, he actually traded bonds. So in other words, if the interest rate market moved, and say it moved lower, whereas when he bought his bonds would move to a profit. And so when that happened, I would call him, and he'd say, well, Joe, what's the premium inside the bonds? I said, well, they're up at $500 per bond, or they're up $1,000 per bond. And he'd say, yeah, let's go ahead and take that profit. Because in his mind, the interest rate cycle went up and the interest rate cycle went down. And so he actually traded his bonds for a profit, much like the stock market, or the bond, so we're on this side. But he traded the interest rate market. So that's another reason to look at these bonds. But he typically only traded tax-exempt municipal bonds, and you can also trade U.S. Treasuries, United States Treasuries, in that same fashion. Some of the things that you should look at is the maturity date. Now, what's interesting about the maturity date is typically the longer you go on a bond, the higher interest it's going to pay. So, for example, if you're looking at CDs, the most people want to go for a CD is maybe 5 years. But that's not the case in a tax-exempt municipal bond. I mean, it's very common for people to buy 30-year bonds, 30-year, 25, 20-year bonds. But you say, oh, well, Joe, they go, I'm not going to live that long. Again, we go back to the reason why you're buying them. Are you buying them for inheritance to your children? Are you buying to dampen the volatility in the portfolio? But there's another little secret. The other little secret to buying long-term bonds is the call date. So most of these long bonds have a call date feature in them, that they'll call in the bonds and then reissue them. So let me explain. So let's say that you were superintendent of the Conroe School District, and that's a school district on just north of Houston, and you were building a high school. So you go to a company and they issue tax-exempt municipal bonds, and they have bonds from 1 year, 2 year, 3 year, 4 year, all the way out to 30-year bonds. But you want the ability to refinance those bonds, as we say in Texas, refinance. In New York, I think they use the word refinance. It's the way they say it. But anyway, I'm originally from Texas, so we want to refinance those bonds. So what he does, so if he issued the bonds and say they were 4%, 25-year bonds, and then interest rates fell to 2%, which they have in the last 20 years, then he wanted the ability to call those bonds in and then reissue bonds. So he doesn't want to service the debt. So when he gets the payments from all the people in the house who live in the homes, and they're paying for the school district that income, he can turn around and refinance those to 2% and reissue the bonds at 2%. That's why you refinance those things, so you're not stuck paying 4% for the whole 30 years. And that's why they have these call features in these bonds. Well, what's interesting is bonds that we bought for my clients, bonds that I bought for my clients back in the 90s, every one of those bonds got called. I never had one bond go all the way to full maturity because of the call features in these bonds. Now, you can look at that as a good thing or a bad thing. It just depends, because all of a sudden that money comes due and then you can do something else with it. But if you're a true bond investor, it's like, hey, you don't want that money. You want it to be getting it was amazing, but we had some 5%. I think the best I had was a 7% tax exempt municipal bond that was just incredible. But anyway, they all got called because interest rates again went to zero. So again, it's not like your money's tied up forever. The other thing is let's talk about how munis are traded. So munis are not traded on the New York Stock Exchange. Munis are traded individually. So they're done by brokers. So basically they're done between brokers, but there is a big secondary market for tax exempt municipal bonds. So I've never seen a situation where a tax exempt municipal bond couldn't be traded. Typically there's always a buyer out there. I guess it depends on the quality of bond that you're trading. But anyway, that's the secondary market. So you can get rid of them any day of the week. But the problem is if you purchase a bond, say it's a 4% and interest rates go to 5% of your muni, say it's a 25-year muni, then you're going to be selling your bond at a loss, because the people out there can get 5% muni and you're holding a 4% muni, so your bond is going to be sold at a discount. That's the terms we use. So again, you may not want to sell your bond at that time. You just want to continue and hold it to maturity, and you get 100% of your principal back plus interest during that time. So let's talk about, again, the types of bonds. I mentioned that before. They're hospital bonds, schools, housing bonds, etc. Now, it makes sense because it's unfair to these school districts and hospitals and everybody to have a service debt and pay taxes, and there's nobody who will give them money to buy these bonds. That's why the government gives them an exemption. The other thing to consider is what state you live in. Not every state is 100% tax-free on other bonds. So let me explain that. For example, I'm a registered investment advisor in the state of California, and I'm a registered investment advisor in Texas, Georgia, and Florida. But it's interesting between the Texas and Florida because those two states don't pay state taxes. So as an individual of Texas and Florida, you can buy bonds anywhere in the United States, and they're exempt from federal, in general, they're exempt from federal and state tax. But not so in California. In California, if you turn around and you buy a Nevada bond, then you'll be exempt from federal tax on it, but you probably, and I don't know for sure, got to check with your tax person, but you probably have to pay state tax on that Nevada bond. It's probably not exempt from state tax. So typically for my California clients, I had to get California bonds. And I'll tell you a quick story at the very end that's going to talk about it's important to do your research and to know how to buy these types of bonds. It's not like you can just arbitrarily go out there and start buying tax exempt municipal bonds. You really got to know how to purchase these investments. Now, the credit worthiness is one of the key things to a tax exempt municipal bond, and there's rating agencies for it. So typically the highest rating is AAA. So they have a AAA rating, and many times a AAA carries insurance with it. It's funny, before the financial crisis, and I remember you could get I remember Houston, Texas bonds, for example, were AAA rated. But after the financial crisis, the Houston, Texas bonds would only get a AA rating, and they wouldn't get the AAA rating unless they bought the insurance on the bonds. So it's funny how the financial crisis of 2008 changed the face of the bond market. And I believe that still may be the case, but again, I have to double check. It's always good to check to make sure that if you are getting a bond, if you do want the insurance, you can. Now again, by getting the insurance, you're going to get a lower rate on the bond, and we'll talk about that in just a second. But I mentioned how muni bonds are trading. Oh, we're at that area now. So the more secure a bond is, the more credit worthiness that a bond has, then the less default risk that you have, and then the lower the yield for the bond. The higher risk of default, the higher yield you get. So it's interesting, like the guy that I was talking about before, the wife who traded equities, and then the husband who traded bonds. He traded bonds, so that particular individual bought investment grade. He bought double A, triple A. He even bought some triple B bonds. And but he was looking for an interest rate move to trade them. But on the other hand, if you're using them for inheritance, you don't want to run through the risk of maybe a municipality going into default. Now, before I tell you this story about what really happened and why it's important and happened to myself and my customers, the last thing I want to talk about is monthly income. So if you are setting it up for the first reason, I said that you may want to get monthly income from your tax-exempt municipal bonds, is tax-exempt municipal bonds pay every 6 months. These are the individual tax-exempt bonds. So they pay like in January and July, all right, February and August. So if you are setting up a tax-exempt municipal bond portfolio, not only do you have to deal with the maturity, if you want 10-year, 15-year, 20, 25-year, 30-year, you have to deal with when they pay. So you'll physically have to have your investment advisor set up this portfolio of bonds that pay, in January, in February, in March, and like that. And then you normally want to set them up to where they're paying money every month. You're getting a check. And so you do that by looking at the payment date of those tax-exempt municipal bonds. So there is a little bit of homework that you have to do on those investments. Now for the story. So I had these California customers. They're not clients anymore. I'm not going to mention their name, but they were high net worth clients. And this one client, actually it was several clients, but I picked up, we bought several issues of California tax-exempt bonds all over the state. But one of the issues that I bought was Orange County bonds. Now, when I went in to buy those bonds, I am very particular about picking up tax-exempt municipal bonds for customers, and I know what type of bonds to get. And in other words, and the reason behind it. It goes back to the reason why a person wants these bonds. And in this particular case, he was using these for inheritance. So in that particular case, I got the best bonds that were available for that municipality. Now, Orange County had bonds all the way from less than investment grade junk bonds all the way up to investment grade bonds, and then in the investment grade they also had the highest rated bond, the AAA insured. So those are the bonds I got in that particular case. And wouldn't you know it, that Orange County defaulted on the bonds. So several other investment advisors bought different types of bonds, and they lost all their money for their customers because Orange County went belly up. And so that also happened to Detroit. Detroit defaulted on their bonds as well. So, the news broke. It went all over the United States. And then, but I knew what kind of bonds that I had purchased. And I get a call, the customer's at the airport, and he calls me, the phone rings. He says, Joe, this is, I'll change the name, John Smith. And I said, "Hey, John." "I just heard on the radio that Orange County defaulted on their tax exempt municipal bonds." He says, "Is that correct?" I said, "Yes, sir, that is correct." He said, "So do we own Orange County tax exempt municipal bonds?" I said, "Yes, sir, we own about $200,000 worth of Orange County tax exempt municipal bonds." And I don't know if that's the same amount. I'm just making that up, but it was a lot. And he said, "So what does that mean to me?" I said, "Well, you get all your principal and interest 100% back, repaid to you." And he said, "How's that possible?" I said, "Well, the particular type of bond I got in this particular case was a AAA insured bond." And so he said, "So what's the downside?" I said, "Well, the downside is that, we got," and I don't know what maturity is, but I'll make it up. I'll say a 25-year bond. And normally these things will have a call date of 12 years. So in 12 years he'd get his money back, and then he could, get something different, or buy another house, or whatever he wanted to do with his money. And I said, the only downside is that we have to hold the bond to maturity now. And actually, it's the insurance company who's paying the interest for the full 25 years, and at the end of the 25 years you get 100% of your principal back. And I believe the insurance company was MBIA. There's several insurance companies now today. That's another thing that I want to talk about real quick, is the insurance company, because and let me just finish the story. So he said, "Oh, so we're all set then?" I said, "Yeah, you don't have to worry about it." Click, hung up the phone, he was done. So it was important that in my case, unlike several of the other investment advisors who bought the wrong bonds and lost money for their customers, I bought the right bonds, so my customer was intact. Now let's talk about buying bonds, and this happened because of 2008. And let me tell you what happened in 2008. So it's not just important that you say, "Oh, I'm going to get a AAA insured bond." In 2008, not all the bond insurance companies honored the default on the muni bonds. There were several companies who didn't honor that because they didn't have the money. In other words, so many muni bonds defaulted that the there was so much more an obligation that the insurance company had to pay, that they just didn't have the money. So the insurance company went belly up. So now it's interesting in today's world, when you're buying your tax exempt municipal bond, and if you're getting AAA insured, and the word is insured, instead of looking at the municipality, now you have to look at the insurance company who's insuring the bond. And that's what changed in 2008. So if it's not AAA insured and it's AA or below, and you're buying the muni, if you want to get a 4.5% or 5% muni versus a 4% AAA insured, and you're getting a AA or A that's 4.5% or 4.75, you can get a higher yield. But if you're doing that, you need to look at the municipality, and you need to look at the credit worthiness, like who's paying the interest payments. Is it a company, or manufacturing, or housing, or is it a general obligation bond? But you have to look at the credit worthiness, and that's how the rating agencies help you on the municipality. But if you're getting an insured bond, boom, stop, you need to turn over here. Now you need to be looking at the insurance company who insures the bond, rather than the credit worthiness. And I don't want to say rather than the credit worthiness, you look at both, but it's more important, in my opinion, to look at the insurance company who's insuring the bond, to make sure that they have enough capital to cover the bond should the municipality default and go belly up. Anyway, that concludes my presentation, my educational class on tax exempt municipal bonds. But I did want to talk about it and bring it up again, because again, we haven't seen these yields in 20 years, and only in the last 6 months have they been timely. And so now, again, if you had an investment advisor and he set up a portfolio in the last 15 or 20 years, he probably didn't recommend any bonds at all, because interest rates were zero, for the Fed funds rate, and it's, for many years, and then bonds weren't paying anything. But now today it's changed, and so it'd be kind of sweet to get on a taxable equivalent yield basis anywhere from 5 to 7%, guaranteed. I'll say guaranteed by the municipality, but that'd be sweet to get without having the volatility of the stock market. So now investment advisors hopefully will be re-looking at fixed income securities for you and be recommending that for your portfolio. Anyway, if you have any questions, you can give me a call. Joe Cantu. Bye.
Welcome to Retirement Tactical Money Management. Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager. Over 10 years ago, he created Cantu Tactical Wealth Management, which actively balances and selects investments based on a tactical approach rather than the traditional strategic management method. Instead of the buy and hold philosophy, he believes in the pursuit of finding investments showing momentum, performance regardless of the direction of the market. His experience includes IRA accounts, 401k rollovers, trusts, endowments, defined benefit plans, 403bs, and 401k plans. Additionally, he served as a night college instructor for seniors, teaching high net worth retirement and estate planning for 14 years. Podcast views and personal opinions are for educational and entertainment purposes only and does not constitute a recommendation. Investing has risk of loss, and you should consult with your own advisors for any financial decisions. Cantu Tactical Wealth Management is a fiduciary, registered investment advisory firm in the states of California, Florida, Georgia, and Texas, providing pure independent advice and money management.